Yeah, I was talking to myself. Anyway, where were we? Guys, thank you for joining this webinar. This is Mark from FX Instructor. I usually cover the ECB announcement. Now, is there anything special about the ECB announcement today? What are the things that we should consider as far as this rate decision is concerned? Well, let's talk about the forecast first. Consensus forecast says that the ECB will probably keep rates where they are. They're not going to move. They're not going to cut. They're not going to do something at this point. But I would also point out that it's been 3 months since the last rate cut by the ECB. That surprise rate cut into that surprise cut into negative interest rates. So why does it matter if it's been 3 months? Because normally the impact of a rate cut or a rate hike by a central bank takes about 2 to 3 months before it gets felt in the broader economy. So at this point, we can say that the decision back in June should now have an impact for the man on the street with regard to how his economic welfare is doing. And because of this, it is possible for us to argue, excuse me, because of this, it is possible for us to argue that the ECB may surprise us by lowering the interest rates again, okay, by pushing deposit rates into negative territory as well. In fact, there are people out there who are talking about maybe we can get a 10 BPS cut in Eurozone rates in general. And if this were to happen, how are we supposed to respond? Well, any rate cut is, of course, something that would be considered as bad for your local currency, for the domestic currency, in this case, for the euro. So we don't expect any rate cut at all to happen. But if something were to occur, that would be an immediate excuse for us to start thinking about shorting our euro. That would be an immediate excuse for me to think about, can I get to 27.88 now? Okay, like we said, not very likely. What are the other options that the ECB could do? In fact, what is the main storyline that a lot of people are watching out for? The main issue, or the main storyline that people are looking out for is the idea of a full-blown quantitative easing. What do we mean when we say full-blown quantitative easing? Basically, you're saying that you have the ECB, and the ECB has begun to just buy and buy and buy government securities in the Eurozone. The same way that in the US, when the federal government needed money, there was the Fed before, and the Fed would just say, okay, you need money, let me print you this much dollars, let me print 20 billion, let me print 50 billion, and I will pay whatever bond that the US government will do. So full-blown quantitative easing means that you could have a situation where a European government, maybe the French or the Italians or the Spanish, would say, we need to raise cash, and ECB, can you help us? We need 30 billion euros. ECB, can you buy 30 billion euros from us? Now, the ECB is not cash rich. So in order to pay for that 30 billion euros, the ECB gets forced to print money. So that is what we call a full-blown quantitative easing. And if you remember supply and demand, let me just do this. Let me bring out the annotation tool. If you guys remember your basic law of supply and demand, right? Let me just draw this chart. And what do you have? This is your demand curve here. This is your price level here. This is your supply. And according to that law of supply and demand, prices of stuff, I call it stuff, or prices of anything, is basically the result of the intersection between your supply line. Okay. This is your supply line or aggregate supply line. And your demand line. Oh, sorry, I got it. Let me erase this. Oh, I can't erase it. So basically, your how do I erase this? So basically, prices are intersection of your supply line and your demand line. And what am I trying to point out? I'm trying to point out that if the ECB says, okay, I will buy whatever bond that the Spanish government, the French government, the Italian government wishes to issue, then that means that the ECB will start printing money. And as you start printing money, you increase the amount of money in circulation. You increase the number of euros in circulation. And if you increase the number of euros, the number of something, you increase the supply of something, you end up lowering the value of that something. So in a situation where we get a full-blown quantitative easing, you're going to have to expect that your currency, in this case your euro, would really be taking a hammering. If there's a rate cut today, which again is not likely, but should it happen, I would expect your euro to ease off, maybe push a little bit more than your normal average range, maybe even close the day below 3107, which is our previous low, which I consider to be a moderate support. So that's my minimum expectation. Give me a close under 3107. Maybe let me end the trading day at 3100. If we have some form of announcement about negative interest rates, about cutting rates some more. But if we have an announcement of, yes, we will buy whatever bond that any government in the Eurozone will issue, that's full-blown quantitative easing. Now, under those circumstances, I would quickly look for your euro to try to ease down. I would look for your euro to try to quickly ease down towards your 61.8 retracement of this rally. And that rally is from, okay. That rally is from August of 2012. So that's how sharp a sell-off I would expect if we're going to get such an announcement. Now that's not going to happen overnight, but give it a couple of weeks and we will get there if that situation, that announcement were to happen. So that is the biggest issue that I would be watching out for. Okay, let me read some of your questions, guys. MRC, where's a pullback due to euro and to what level? Honestly, if Draghi does not sound dovish, I would really be attracted with the idea of, can we cover the gap that we had in your euro? You remember, 2 weeks ago, you gapped lower at the open. So for me, no announcement about um, future rate cuts, no announcement about uh, printing money, buying government bonds, then I would look for a bit of a technical pullback. I would think in terms of, all right, let me buy it from that support at 3107. Let me see if over the next couple of days I get to cover your gap. I get to push towards your 3243 area. That seems to be a good place now. You have your daily email lines there. But I will only look for that if there's no hint at all about a dovish bias. And how likely is it that the ECB will not have a dovish bias? Well, let's put it this way. Inflation in the Eurozone is at 5-year lows. Although there's been a pickup in economic activity, it has not been consistent. The recovery is losing some steam. So under those circumstances, if I were a pen and fire, rates are already negative, but you have a situation where there isn't much inflation. Well, let me put it this way. As long as the economy is slow, as long as unemployment rate is still pretty high, and as long as there's no inflation, there's really no reason for ECB to start thinking about raising interest rates. Okay, there's that German view about preventing inflation from creeping up. There's that German view about austerity. However, I think that if you look at the last couple of years, the one country where we seem to have a good amount of recovery, or those countries which seem to have recovered quite well from your crisis, were what? Were countries that adopted aggressive quantitative easing. These are countries that were willing to say, okay, you know what, we need to create jobs. Let's lower interest rates. Let's make doing business cheap. Let's encourage people to spend. And that effectively is really what lowering interest rates is all about. You try to encourage businesses to invest. You try to, by tempting them with a lower cost of capital, you to encourage people to spend money instead of hoarding it under their bed, because keeping your money in the bank will not pay. So I'm not sure if I would call QE as not making sense, considering that there's no inflation to speak of, and people would want a faster rate of growth for the Eurozone. You need to, yeah. So it's basically that. The fact that inflation is almost zero. If it picks up, then that could alter the scenario for us. So in any case, guys, as far as trading the ECB decision is concerned itself, we doubt that there will be any discrepancy between your consensus forecast and the actual results. The main issue really comes from what happens next, your press conference, because that's where policy direction gets elucidated for us. Now, and that's really where things get interesting. During the rate announcement, you're not going to hear Mario Draghi say that I will start buying this government debt. But during the press conference, he will be questioned by the press, and he gets to explain, what will I do next? And it's under that condition where you're really vulnerable in terms of having a response to market development. So what are the things to watch out for? A lot of the speculation is that there will be some form of announcement during the press conference. The announcement would be in the way of outlining the conditions where the ECB might decide to buy debt from the market. You know, when you say that the ECB's, Chris, yes, he's normally that, but it's been 3 months since his last decision. So we may be surprised. Oh, by the way, folks, the ECB has actually already hired BlackRock to help them in designing and structuring how some of these asset purchase programs will work. So clearly, there is an intent to eventually take that kind of action going forward. And like we said, it is measures that involve this purchases of assets by a central bank, which leads to a weaker currency because the money that the central bank uses typically comes from its own coffers. So the central bank is forced to print the money to buy these things. Well, I'm not in Europe, so I really cannot tell. But there were reports about shrinkflation, basically items that you were buying before seems to be smaller because the producers, the manufacturers seem to be cutting down on their costs as much as possible. So these could be not quite statistical inflationary effects of having a lot of money going around, but it would still be seen as inflationary, as an inflationary event or as an example. Adi, GU. All right, so guys, let me take a quick peek at GU. If you have any questions on Euro, by the way, we're only 7 minutes until your rate announcement. But let me take a quick look at GU now. So GU, as expected, the same decision for everything from the UK. It will be 2 weeks before we actually see the split on how the BOE MPC voted. So why is that important? Well, you have to remember that the last time we had the BOE minutes, we were surprised by a split in the votes. There were people who actually called for a rate hike in the UK. And, well, in 2 weeks' time, if you get another such split, it creates that atmosphere, it creates that idea of perhaps we are through with our sell-off in GU. It's dropped by a lot so much. Maybe it's time for us to look for a bounce. Okay, that is a possible scenario in our GU. But again, you will only get to hear that confirmation 2 weeks from now. Technically, well, we're in the process of a bearish breakout. You've lost your bearish momentum, but you now have new lows. So you're now opening yourself to possibly easing down to 38.2 fib retracement, the 60 to 83 area. Well, Chris, if NFP is a disappointment, there is a risk that your GU will bounce. So maybe NFP comes out 170 or merely 100. Under those conditions, you risk the dollar getting dumped. You risk seeing your GBP USD coming off that 6,400 area. Guys, we are 5 minutes. Well, if it's over 200,000, I think that should be considered as good for the US. Remember that used to be 150,000 was a big deal in your NFP numbers. Yeah, and that's the excuse that you need to get to 6283 sooner rather than later. If you have numbers coming out a lot better than the consensus forecast. So as far as G is concerned, watch out for tomorrow's NFP. Your earlier rate decision isn't all that critical. Hey, this Vista. Yes, economy on the rise, so NFP should improve. Well, yeah, basically that's the argument there. You cannot have an economy that's improving, especially you cannot have a sustained recovery in an economy if you're not creating jobs. I don't even want to trade your commodity currencies on a US data. Remember that to some degree, good US data becomes good for a commodity currency, especially your Canadian dollar. Say your NFPs tomorrow will read 250. That's very good. And that means more consumers. More consumers will always benefit a commodity currency. So your knee-jerk response could be to actually see your Japanese yen, your USD JPY selling off. Well, good luck, Chris. So guys, we are 2 minutes away from our release. Let me just get back to overview. Again, we don't really expect any changes in interest rates, but nonetheless, it doesn't hurt to watch. We are 1 minute and 20 seconds away. So guys, we are about 1 minute away from our release. Not that we're expecting anything. And like we said earlier, what's really important will be the press conference 45 minutes after. Hey, thanks, Chris. All right, folks. Where are we? We are 30 seconds away, or like 15 seconds. Even though we don't expect any changes, I wouldn't suggest that people take action before the release. Wow. We're seeing a quick sell-off. Thanks, Chris. All right, guys, let me just verify. We're seeing a sell-off. Normally, I would have associated this only to happen if there's been another cut. And they did. So we have a surprise. They cut their minimum bid rate by 10 BPS, 10 basis points. So how low can we expect our euro to get on this one? Well, you know what? With this rate cut, then it's unlikely that they will be talking about printing money anytime soon. We already have a break of 3107. I would look forward to us getting a very quick sell-off. Something I'd like you to look at, guys, is EUR and ZD. Why EUR and ZD? Oh, okay. It's actually, we already have it. We already have a big sell-off. I was hoping that it hasn't moved that much yet, but we've already more than exceeded average changes. Still, we would look forward to any pullback play, any rejection from your daily EMA lines. MRC, from the looks of it, it will be quite a while before it gets filled. Eventually, it will get filled, but it's not going to be a technical story anymore. Just because perhaps at that point in time, you have your euro rallying again. But what we've been given is an excuse to just expect a weaker euro, to go beyond average range. In fact, you've already doubled your average daily range in EUR USD. There will be positions squaring. There will be some profit taking. I would say wait for the end of the R. At the end of this R, you risk some profit taking. Yeah, there will be a lot of people who would want to, hey, I've made some money, let me get out. Let me book it before it turns to a stone.